Hey everybody, RC Peck here with my weekend investment thought, and I want to talk to you about independence. This week, 241 years ago in the United States declared independence against British rule. And so a lot of times the word independence and freedom go together. And I just want you to think about what comes with being free or having that independence, because there's a lot of people that still have the long-only big box advisor managing their money. And even though they see that they'll never get out of the market when the market corrects or falls, one thing they get by staying in that long-only big box kind of conventional relationship is they get to blame someone. They get to blame someone when something goes wrong. And when you take your own independence, when you take that, and it is something you have to take, you can't blame anyone else anymore. And there are a lot of people who get a lot of value in being able to blame people. So with that, I have 7 price charts that I want to show you. I don't want you to blame the price charts, but I want us to both look at these price charts. And 7 price charts are very similar. These 7 price charts are very similar to each other. And I want to look at them and talk about whether there is a market peak. Is the Dow Jones peaking out just because it's at lifetime highs? So let me get behind the computer and let's look at those 7 price charts and see what they're telling us to give us that clarity and that stability and that freedom and those choices and that stableness that we want. So give me a second and let me jump behind the computer. All right, give me a moment. All right, everybody, I am behind my computer and I have a special guest with you. But before I talk about my special guest, I want you to know that I am recording outside. So you will be hearing outside noises, cars, maybe a garbage truck, I don't know, and some nature noises. But my special guest is my beautiful daughter. Do you want to say anything?
Hi, everybody. Have a good weekend.
All right. Thank you, sweetie. Okay. The other little person in my life, he has decided that sleeping in is a really cool idea. So he is sleeping in right now. So guys, I have 7 charts for you. And before I get into the charts, kind of an overriding theme is independence. It is Independence Day this week in the United States. And I saw this and I kind of thought a lot of what independence is thinking for yourself, pointing out things that you know are not right. Sometimes you have to stand on your own. Now, you don't literally need to be on your own, but it's probably going to be a smaller group when you go up against something that is not working. And the long-only big box approach, it worked great in the 80s and the 90s, and it just hasn't been working since 1999. So let's get to these 7 charts. The first chart is a 3-month Treasury yield chart. So this is the actual yield of the 3-month Treasury in the US. Now, I want to point out a couple things because all 7 charts are going to have some similarities. One, all these charts go back to 1982. So you can see when the peak in yields happened way over there to the left. And you can see they've been falling since 1982. And I'll come back to that because it's very important. But here's the 3-month Treasury. The Fed pretty much controls this guy. The red dots are where the stock market peaked in 2000. So this first dot is where the stock market peaked, and it fell all the way to the green dot. And as you can see in between there, we got a gray bar, vertical gray bar, which was a recession. And just notice how much yields fell. They went from 6% eventually down to 1%. So a pretty significant fall. And then in the global financial crisis, the second red dot and a recession, yields fell from 5% all the way down to 0%. So both times the 3-month Treasury fell 5%. And the Fed controls the 3-month Treasury. So what do you think is going to happen when we go into our next recession? Last 2 recessions, and this is pretty significant. I didn't show all the recessions on these charts. I just want to show the last 2 because I believe that the world changed in 1996 when Netscape IPO'd. But notice that the 3-month Treasury dropped 5 percentage points. If that happened today, we'd have a negative 4% yield on the 3-month Treasury. The next chart I want to show you is the 6-month Treasury. Now you might be thinking, RC, this looks very similar to the 3-month. And that is because that is true. You notice here again during that recession in 2001, yields went from about 6, again dropped down to 1, exactly what the 3-month did. And same thing during the global financial crisis, yields went from 5% to 0. Pretty interesting. Yields started rising here in 2013. For the 3-month, they didn't start rising until 2015, which is very interesting. But actually, 6-month are a little bit farther away from the reach of the Fed, and they started rising, or at least they bottomed in 2013, and they've been moving higher ever since. And they have a lot higher they need to go before we get into the next recession to really help people out. But clearly you can see how absurd the behavior the Fed has been with how flat this yield has been in both the 3-month and the 6-month. And now this price chart is the 1-year Treasury. Again, look at this. It peaked. This is interesting. It peaked before the recession, but it peaked right at the top of the stock market peak. Now, again, this is the yield, but I'm putting the red dots in for the peak of the U.S. stock market and the green dots for the bottom of the stock market move. And you can see here on the 1-year Treasury, the 1-year Treasury peaked with the peak of the stock market. But the stock market kept, when the stock market fell and bottomed here in October of 2002, the 1-year Treasuries fell a little bit more right after that. But again, look at the 1-year Treasuries. They went from 6% down to 1%. 3-month, 6-month, and 1-year all did the same thing. And same thing with the global financial crisis. The 1-year Treasuries went from 5% and eventually dropped to 0. So again, all three, the 3-month, the 6-month, and the 1-year all dropped 5 percentage points during the last 2 recessions. But notice here how they're really going up. I mean, this yield is really increasing steeply. This yield is really increasing steeply as the stock market got better. Again, remember, this is the bottom. The green dots are the bottom of the stock market. So that gives you an idea that yields move in the direction of stocks, something that people forget. Here we have the 2-year Treasury. Very similar. Again, a lot of these are going to look similar on the what's called the short end of the yield curve. Notice the 2-year Treasury dropped from 7% all the way down to 1%. That dropped 6 percentage points during the dot-com crash, collapse, fall, correction. Notice the recession happened right in between. But the 2-year Treasury, the yields fell 6 percentage points. That's pretty amazing. And then during the global financial crisis, they fell 5 percentage points. Very interesting, though, because the 2-year, that's starting to get away from the control of the Fed as we move farther out on the yield curve. And now you can see with the 2-year Treasury, the 2-year Treasury, it bottomed in October of 2011 and has been moving higher since on its own, which is interesting because the Fed didn't start raising interest rates until December of 2015, but 2-year Treasuries, which are getting more and more as we go out on the yield curve, the public controls, the market controls the yield curve, and this 2-year Treasury, as the market starts to get more control over this, because of where it is on the yield curve, it starts moving up way before the Fed started moving their interest rates up, which again, the Fed started in December of 2015, and this was 4 years before that. Very interesting. Okay, guys, 3 more price charts. This is the 5-year Treasury yield. Let's go ahead and look at what happened in 2000. So the stock market peaked in March of 2000. And the yield at that time, the yield on the 5-year Treasury was 7%. It dropped all the way to 2% during that recession and market correction, a 5 percentage point drop. Pretty interesting here. And again, like the other yields, the 3-month, the 6-month, the 1-year, and the 2-year, it was moving higher. It was going higher steeply into the market, the stock market peak. And then into the 2007 stock market peak, yields were cruising for years into that too. In the global financial crisis, the 5-year Treasury went from 5% to I was going to say zero, but it only fell 4.5 percentage points, but it fell 4.5 percentage points. That is significant. Now, it did bottom in June of 2012, but notice, I mean, it is moving higher, but it's almost, I mean, it looks like it has bottomed, but this is not a clean move higher. Now, the 5-year Treasury yield is controlled more by the public and by the markets. Here in December of 2015, the Fed started raising rates, and the 5-year Treasury actually fell. That probably confused Janet Yellen and company. But notice I have two trend lines on here. One trend line goes back to 1989. I had to pause because I don't have my glasses on and I couldn't read the chart. So I'm not going to consider 5-year yields really breaking out of their downtrend until it breaks these two downtrending trend lines. Until it breaks those two, it is officially still in a downtrend, even though it has bottomed in June of 2012. The question is, will we see new 5-year Treasury yields low when we go into our next recession? And we are in one of those situations where only twice before in this country we've been in an expansion period longer than we are today. So we do know a recession is coming. Okay, then things start getting interesting with the 10-year Treasury yield, where the market is fully in control of the 10-year Treasury yield. And again, we have the same red dots and green dots. The red dot for the 2000 is where the stock market peaked, and you can see yields moved into that. Yields moved higher into that stock market peak, and as the stock market fell, so did yields. Now here the 10-year Treasury went from 7% and ultimately bottomed about 3.25%. What I thought was interesting, if you look right after the first green dot, there was some panic, right? You see that yield drop really steeply there. That's panic buying. So what was interesting, there was panic buying after the stock market finished falling. And you can see then in the global financial crisis here, during the recession, there absolutely was panic buying during the recession and during the stock market fall. And like I pointed out on the 5-year Treasury, the 10-year Treasury here, it's still in a downtrend. The yield is still in a downtrend, and it's been trending lower since 2009. We did get a bottom here in June of 2016, but as long as this yield stays below this downtrend line, it's going to be hard to say, or hard for someone to say that yields have bottomed. Now, if we break above this downtrend, that's a good sign. And what I also believe we also need in the 10-year Treasury is to break above a 3% yield. And we have not broken above a 3% yield yet. So until we do, it'll be hard to say that 10-year yields have bottomed. Again, my concern here is during the 2000 recession and stock market crash. Well, the recession was in 2001, but they went together. You had the 10-year Treasury falling. It went from 7%, let's just call it 3 for easy math. So it fell 4 percentage points. And then the global financial crisis and that recession, yields went from 5%, let's call it, to 2%. They didn't stay at 2% long. They came back up, and then they eventually dropped down to about 1.3. So in that case, yields fell 3%. What's going to happen during our next recession? Very interesting. Now, a lot of this price chart, guys, I believe has to do with demographics that are going on in the United States. 10,000 people a day retire. When people retire, their earnings runway goes away, and somewhere they were willing to believe those long-only big box advisors that you have to get into more bonds. And I believe that your age determines your asset allocation is going to absolutely cripple people over the age of 50 and 60 financially over the next 2 decades, because as you see here, we're getting close to that zero mark. And the idea that you should be in bonds because of your age is an idea that came out of the 70s, worked in the 80s and 90s. But guys, when the bond bull market ends, that belief is no longer going to work and is going to hurt millions, tens of millions of people. So you have to start thinking independently. You have to start looking at these price charts and say, what is best for me? Not what dogma am I following? Well, you probably should ask yourself, what dogma are you following? Last price chart, guys, is the 30-year Treasury yield. The 30-year Treasury yield basically went from 6.5% to 5.5% in the 2000.com correction and that recession. So not much. It didn't change that much. Now, the 30-year Treasury is 100% in the market's control. The market controls this yield completely. The Fed has no control over it, none. I want to point out two things that I think are interesting. In the global financial crisis and the recession that happened at the same time, notice that this, if you see this big drop here in yields, that's absolutely panic buying. That was panic buying into this yield, into this Treasury, panic buying. But what I also want to point out, which I did with the 10-year Treasury yield, is notice how very clear downtrend since 2009. The market controls the yield on the 30-year Treasury, and it's been in a clear downtrend until these two lines have been broken and the yield is clearly moving up. It will be hard to say that the yield, the drop in the yield for the 30-year Treasury is over. My concern is could we see a 0% interest rate on a 30-year yield? If we do, that might that might be a time where you want to short treasuries. That might give a very high probability sign that shorting treasuries might be the best thing you could do that decade. So what's the takeaway here? So first, yields. Let's get clear on a couple things about yields. One, they rise with stocks. They also fall with stocks. Okay, it might be obvious, but let's point out the obvious here because people don't do that. The second thing is they really drop with recession, guys. We will have a recession, high likelihood of having a recession in the next 18 months. And depending on which interest rate we're looking at or which treasury we're looking at, they will drop 3 to 5 percentage points. That is significant. That means if that holds true, we're going to have a lot of treasury yields in the negative range, which is pretty impressive. And then third, after looking at those 7 price charts, 7 yield charts, yields are way too low on the short end. And that is an effect of the Fed keeping rates way too low. They kept them too low for too long. And that means they're behind the ball. They have less ammunition to work with, and that is going to create much more volatility in the market. You want to know where volatilities come from? It's come from the Fed. You don't have to shame them. They do what they do. That's not going to change. We follow the price charts. We align our money with where money is flowing, and that's how we create stability in our lives. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, I want to say that you belong here, right? If you want investment stability, but you're tired of the hype and the BS, and if you are, in fact, tired of that, let us help you become the smartest investor in the room, really, so you can just stop drowning in the drama and the distraction and get the principles for free. And you do that by upgrading your investment peer group, and you can do that by subscribing to my weekly thoughts. Thank you, everyone, for being in my world, and I'll speak to you guys next week. All right, speak to you then.